Thank you very much. It is a great pleasure to be here. Thank you so much for having me. I toured the museum for the first time earlier this evening, and it really is, just spectacular. It's a little jewel box museum, and I hope, everybody gets a chance to see it. So I am going to talk about New York City, some of the struggles that the city is going through coming out of 3 years of COVID. It's come back differently. The Zoom technology has enhanced communication, seamless communication, has changed the way people live and work. So as they return to New York, return to their offices, they're returning in a different way. The Florida market has accelerated as a result of COVID, and in quite a number of ways at New York's expense. And Florida is just an example of many southeastern markets. It could be Florida, it could be Nashville, it could be Austin, it could be Charlotte. So that's a quick overview in terms of the agenda for tonight. I'll give a quick overview of my company, what we do. Then I'll spend some time talking about the New York City office market. And really, the health and vibrancy of the office market is a good proxy for the health of New York's economy, for businesses. And then I'll talk about where we are as sort of a gradual recovery. Then I'll layer into capital markets. I think we all see it and feel it in the sense of, inflation. We see mortgage, rates going up, but the dramatic rise of interest rates in an unprecedented fashion is having a massive effect on commercial real estate across the country, in particular on office buildings, a devastating effect that's similar to what happened following the global financial crisis. And it's not really visible to you all, but it's going to be becoming more visible in 2024 and 2025 when we're going to start to see major foreclosures, people, some of the largest owners in the United States handing their buildings back to lenders. So I'll talk about that a little bit because that's going on right now. And then I'll layer it in again, touch on what we're doing in South Florida. And how that ties into and how that affects New York. And then I'll make some conclusions that I'll put myself on the limb and make a few predictions, which will probably be wrong, but I'll do it anyway. The nice thing about a small format like this is it can be completely interactive. So I'm going to talk, I'm going to move very quickly, but please stop me at any point. Let's ask questions. I'm happy to kind of deal with any kind of a subject as we go. Okay. So with that, I'm heading the wrong direction. Quick overview of our business. I run a business called Savanna. I'm the CEO and co-chairman. I started with a guy who I went to high school, I grew up with since I was 15 years old. Savanna is an owner, operator, developer, and institutional fund manager. So we raise private equity funds and then we invest them. We've raised most of our investors are pension funds, foundations, endowments, wealth management companies, sovereigns, family offices, asset management companies. So we have a whole suite of institutional investors, probably half domestic and half offshore. So we're in the fund management business, but then when we raise funds, we invest them in real estate, and we invest and develop real estate in primarily New York. Our New York portfolio is about 7 million square feet today, but again, we have a presence that we're growing in South Florida. Sort of a snapshot of our business. We've invested about $6 billion of equity over about 17 million square feet of space over the years, and we have kind of institutional investors that invest with us over the years through multiple funds. One point of differentiation between my business and some other businesses is we're vertically integrated. I'm trying to move this. There. We're vertically integrated, meaning a lot of people who are in my business are just raise money and invest in other people's real estate. We have teams, we have about 90 people across multiple disciplines. So we do in-house acquisitions leasing, sustainability and ESG, which is very important, construction management, project management, legal compliance, financial reporting, operations administration, and property management. So we're actually, when we buy a piece of real estate, we're hiring the architects, we're hiring the engineers, we're deciding which tile to use in the lobby. So we're extremely hands-on, and our view is that allows us to do whatever we do better. If we're evaluating a project, we know what the tile costs. We know how long it takes logistically to get something approved through the building department, and then also how long it takes to execute around an occupied office building. So it gives us insight. Actually doing the work ourselves gives us better insight as investors and also allows us to execute better. So that's a quick overview of our business. We have two offices. We have offices in New York, and we have offices in West Palm Beach, Florida, where most of our investment activities in Florida are taking place. So with that, let's jump into the market and look back before we look forward. COVID hit New York extremely hard. But if you look back in time, New York has gone through a number of different crises. So back here, this is 2001, this is 9/11. So we lost 169,000 jobs at 9/11. As you see, they kind of fell rapidly. Took us almost, we never got there. It took us 8 or 9 years to build those jobs back. So slow recovery post 9/11. This is the global financial crisis. We lost about 100,000 jobs. Again, fell off the cliff. But interestingly, in only about 3 years, we recovered all those jobs in New York City. Now, why? New York began to diversify. New York, when I was growing up, and I grew up in Manhattan, New York was a financial town. It was all about the banks. Half of the occupancy was financially related firms. Starting in about 2000, New York began to diversify. Technology, advertising, media, information, professional services began to diversify. And now New York has become by far the most diverse business base of any major market in the United States. And so what that means is, as the market, it gives it great resiliency. And as if one industry is down, others grow and fill the gap. So New York recovered much more quickly, and then just really surged right up until, and this is COVID, right? COVID, massive, and if you look, it's just a straight line down. We lost 161,000 jobs overnight. Now, interestingly, it's come back faster than ever. We're above pre-COVID employment levels right now. So jobs have come back. It's not really a job problem, right? Jobs have come back. Now this is leasing. New York, just to put it in perspective, and it's massive, is a 450 million square foot office market. That's larger than the next 2 or 3 markets combined in the United States. So massive market. And this is sort of pre-COVID, starting in 2017. You see, this is quarter by quarter levels of leasing activity. So again, COVID hits, falls off a cliff. It's down to about maybe 30% of what it would have been in a normal year for a number of years. That's mostly just tenants renewing in place, not expanding, not moving, just trying to keep the lights on and stay in business. You see, this is what happened during COVID. Well, it started to come back. And in 2021, it came back, and it actually kind of had a recovery year, began to peak. And in a lot of ways, and this is when interest rates started to spike and businesses got a little more conservative, and that's about 20 months ago. So it's down, but leasing in many ways, which again is a mark of business diversity and business confidence, leasing has largely, it hasn't come back to where it was before, but it's come back in a reasonably robust way, and I think will continue to come back. So again, jobs have come back. The leasing market isn't where it was, but has come back very substantially from its lows. And this is business diversity, right? This shows the pie chart that shows where the leasing activity is. This is pre-COVID, 2018 to 2020. First of all, what I should have shown, which isn't on here, is if you'd shown this same pie chart in the year 2000, half of it would have been financial services. Half of the entire pie would have been banks and asset management companies, financial firms. So you can see by 2018, we have an incredibly diverse market. And TAMI is technology, advertising, media, and information. So multiple different categories of businesses are in here. Financial services are banks, hedge funds, private equity funds, asset management companies. So again, an incredibly diverse pie. And what you see is, as we've talked about the recovery of the New York market, well, what really drove the market from 2010 to 2020 was TAMI. This was Google expanding in New York and Facebook and all of the big technology companies. Well, while they've pulled back post-COVID, what's filled the pie? Financial services. Jamie Dimon, the head of JP Morgan, is saying, come back to the office. You know, butts in seats. So you have the financial services industry now really driving people back to the office, and you see it in the numbers. So, and just by way of comparison, at the bottom of COVID, at the worst of COVID, the office occupancy was 2%. 2%. Like, no, literally, it was a ghost town. This is 2022, 38%, 2022, 23, 52, 2023, almost 60%. Now that's actually much, much better than it sounds. It was never 100%. 63%, 60% is not off 100%. At any given time, an office building is maybe 90% leased, 92% leased, and at any given time, someone's traveling, someone's sick, someone's not coming to the office. The baseline number is really 75%. So we're now up to about 60 relative to 75. It's actually pretty good. We're getting back there. So people are coming back jobs are back, leasing is back. Office occupancy, again, isn't where it is, but it's coming back. So in many ways, the economy of New York and the business base and the leasing activity, all of which are indicators of the health of the city, is coming back. But it's not coming back in the same way. And before we go on, I just want to show, these are all the major markets in New York. This is kind of what activity was before COVID. And I'll just use San Francisco as an example. San Francisco is fallen off the charts. Why is that? San Francisco is a technology town. It is all about, you know, Microsoft and Google, and that represents the overwhelming share of the business base in San Francisco. It is not a diverse town. And those are the companies that aren't coming back. Those are the ones that are most remote, have the biggest remote work from home policies. So the vacancy rate in the office sector in San Francisco today is 25%, but 20% of the office is available for sublet. So almost 50% of every square foot of office space in the city of San Francisco is available to lease. It's like a neutron bomb has gone off. So lenders won't lend against office buildings in San Francisco. But interestingly, again, cities are different. They're culturally different. So in San Francisco, the tech firms set the culture. The culture is work from home. So people don't go into the office. So even if you're not in the tech sector in San Francisco, even if you work for a law firm, you work from home. Even if you work for a financial firm, you work from home, because the culture of San Francisco is work from home. So very different than New York, where the culture is come back and come to the office, even though people are coming back differently. And you see that New York, Midtown Manhattan, it's spiked. Okay, it's above where it was in years past. And that's being driven by people coming back. So now, but now here's the difference. When people come back to the office now, they're not coming back to the same buildings, they're not coming back to the same work environment. And broadly speaking, better buildings in better locations, close to hubs of transportation, are actually doing pretty well. And buildings that are in secondary markets, that have not been improved, and that are difficult to get to, are doing really, really badly. And you see it in the data. I think people don't realize New York was built, it's an island, Manhattan's an island. It was built 100 years ago. And almost every square foot was built 100 years ago. So even though the market is 450 million square feet of office buildings, the average age of an office building in New York is 85 years old. Buildings that you think of as iconic buildings, the Rockefeller Center is 90 years old. The Empire State Building is 90 years old. Like the Chrysler Building is 90 years old. So New York has this incredible landscape of amazing buildings, but most of them are really old. And it's actually very hard to build a new building in New York because you have to empty an old one in order to find the spot. You have to empty an old one and then build something new on top of it. So it's very hard to add to the supply. So 25% of the entire housing The entire office building stock of New York is put what's called in the better building category. 75% are these older buildings that are not improved, that are not particularly well located. So this is leasing. Almost 70% of the leasing is being done in 25% of the buildings post-COVID. And that's because post-COVID, as employers are trying to bring their employees back into the office, no one wants to take a commuter rail into the city, a subway, and a bus to get to, 3 modes of transportation to get to work. People want to take a single mode of transportation, get off, and walk to work. So better buildings that are centrally located are drawing people back. And when tenants are now looking, they're trading up to these better buildings. They want to know the air handling systems work and their amenities and improvements. So again, a group of the better buildings in New York are actually doing pretty well, but at the expense of buildings in the Brooklyn Navy Yard or in these areas that pre-COVID were kind of hip and cool, or old buildings that were sort of hip and cool. I mean, you can't give the space, you can't give those buildings away today. And again, it's reflected in the data. The overall vacancy rate today is about 19%, call it 20%. Better buildings are about 17%, but better buildings in Midtown are 12%. Market equilibrium is 10, so they're doing pretty well. But again, people are coming back to the office, but they're coming back to better buildings, and they're also coming back in flexible work formats. We're a real estate company. We have every incentive to be in the office. I actually believe philosophically that being in the office is great. I don't think if you're 22 years old or 24 years old and your first job, like working at home in your pajamas, is a great thing. I think that's a pretty bad idea. I think you learn from your peers, the interaction between you and your colleagues, the relationships you develop, all that's incredibly important. So I believe in working, going to an office and working. That being said, we've established 4 days in, 1 day out. We give somebody, and it's because it's just expected. Like if you don't do that, your employees at this point, I'd rather be in 5 days a week, but our employees expect some degree of work flexibility. So even firms like my own are incorporating work from home. More typical is 3 in, 2 out. So the workplace has changed, and some degree of work from home is incorporated in almost every single business, and even the big financial services companies that are trying to bring their employees back are doing some level of work from home. My daughter's boyfriend, who's a year out of college, took a job with KKR, one of the big hedge funds. They serve those kids breakfast, lunch, and dinner every single day. And it's really good food, right? He's trying to save money. He eats breakfast, lunch, and dinner every single day at the office, right? But that is what they're doing to bring people back, and it's working. So, in conclusion, before we move on to the next section, 3 years of COVID followed by 2 years of the capital markets crisis has really impacted the market, major impact on the market. People are returning to the office, but that return is unequally distributed, with better buildings in better locations, on transportation doing better at the expense of secondary buildings. And New York, as a major market, is outperforming many of the other big cities across the country because of its extraordinary diverse business base. And fundamentals, while they're not going up like a hockey stick, are gradually recovering. So that's kind of the good news. So now I'm going to go into the bad news. Again, we see it in mortgage interest rates, we see it in inflation, but this is what's happened to interest rates over the last 20 months. And no one's ever seen this before in their lifetimes. In 20 months, interest rates have gone up 525 basis points. And you can look here are other periods of time. At other points of time, interest rates have risen much slower, gradually over time. People have been able to adjust. So why does that matter? Every piece of real estate is financed with debt, right? Real estate is a business, just like most people buy their homes with debt. Every commercial real estate owner buys their home with debt. And most people don't, it's not like when you buy a commercial office building, most people don't get 20-year fixed rate debt. You get variable floating rate debt. Or you get debt that's 3 years with 2 one-year options. In my business, everyone in my business gets debt for 3 years plus 2 one-year options because we have a strategy. We're buying a building, we're improving it, we're making improvements, then we're selling it 4 or 5 years later. So we're transitioning buildings and improving them. $1 trillion of debt is coming due over the next year in commercial real estate. $1 trillion of debt is coming due. So what happens? This is what happens, okay? This is a really good office building in the heart of Manhattan 3 years ago. 3 years ago, if you had $5 million of net income from that building, right? And what that means is you collect the rent from the tenants, you pay your real estate taxes, you pay your expenses of the building. At the end of the day, you have $5 million of cash. That's your net income. A really good office building that's well located, that has long-term tenants with good credit. So we're not talking about a bad piece of real estate. We're talking about a really good building in a really good location. 3 years ago, if you had $5 million of net income, you would have valued that building at about a 4.5 cap. That's how you value commercial real estate. It's a capitalization of income. And the building would have been worth about $110 million. And if you were normal, you weren't trying to push the edge of the envelope, you'd be carrying about 65% debt. So you're carrying about $72 million of debt on that office building. And then you'd invested $39 million of equity. That's very typical. It's not being crazy. It's not pushing yourself out there. That's a normal capital stack. And in those days, you were probably paying 3 years ago 3 to 4% on your debt. So $1 trillion of debt is coming due. And your lender now says, okay, your debt's coming due, take me out. You owe me $72 million. So now what you do is you go to the refinancing market, you try and find a new lender who's going to underwrite your building and take out your $72 million. Your old lender's saying, pay me $72 million bucks. So when you go to the market, how is that underwriting changed today? Well, you can back into it by a couple of different ways. At the simplest level, and this is probably optimistic, it's a 6% cap rate. Your building isn't worth $110 million, it's worth $83 million. And lenders are more conservative, and they're saying, we're not going to give you a 65% loan, we're going to give you a 50% loan. Your lender will give you $41 million. Your old lender is saying, pay me 72. Your new lender is saying, I'll give you 41. You have a $31 million gap. Okay? That's not a bad building. That's a good building. That's every good building. Right? And that's a small building. By New York standards, if it's a $10 million NOI, you have a $60 million gap. So I run a pretty large institutional fund, and really well capitalized owners don't have $30 to $60 million in a bank account just to own the same building tomorrow that they owned yesterday. Like, that doesn't exist. And the scale of this is enormous, and again, you can back into different metrics on how you get there. You can also say, all right, if I have $5 million of net income, a lender will apply underwriting standards, and they'll apply what's called a debt service coverage ratio of 1.25. And they'll say, of your $5 million, we'll finance $4 million of cash flow. But now they're not pricing that to a 3 or 4% yield. They're pricing it to a 9% yield. Gets you the same $42 million. Either way you do it, your old lender is saying, give me 72. Your new lender is saying, I'll give you 40. You're $30 million short. That's happening to every building in the market right now. So you're not seeing it. We've been in it for the last 2 years. But that is starting to become visible. Like what we saw in the global financial crisis is starting to happen in the commercial real estate sector. So you're starting to see lenders throw up their hands and say, I'm just going to sell my loan, right? I want to get out of this, and I'll take what I can get. So, and you're seeing major lenders. These are examples of major transactions that have happened recently where the lenders have just said, I'm done, I'm going to sell my loan. I'll take 60 cents on the dollar, I'll take whatever I can. Or you're starting to see some of the largest owners in the country, Blackstone, RXR, CIM, these are huge companies, they're giving their buildings back. Major buildings on 6th Avenue, they're handing back to their lenders, and they're just saying, we're done. So this is happening now in the market. And you're also seeing, sellers who they can't sell their buildings. There is no bid, and because people can't find any financing, and so the sellers are trying to provide below market financing just to create a transaction. So this is happening in the market right now, and I think we're going to see it. It's going to get much worse before it gets better. We're going to see this in 2024 and 2025 flow through the market, and it's going to have a major impact. So that's sober. It's gradually recovering fundamentals, which is great, right? People are coming back, they're going back to the office, jobs are back, but it's underlying it is massive capital markets problems that are surfacing and that become visible across the business. All right, so now I'm going to go into South Florida, and to jump to the punchline, what we're seeing in South Florida is very, very substantial wealth and business transfer from New York to South Florida. Sort of like getting on the plane and going down. It's been happening for a while, but it has accelerated in recent years. So to just kind of go through the high level. Okay, so for 2 decades, South Florida has had growing, Florida in general, growing population, a positive population growth, and then a lot of business growth. Businesses are going down there, and why are they doing? Well, they're going for favorable climate. They're going for lighter touch regulation. It's easier to do business. They're going for lower taxes. And those trends have been in place for 2 decades. COVID accelerated all of it. During COVID, especially, as people went into lockdowns here, people went down to southern Florida, and it started to be 365, 24/7. The real estate market was on fire. You had massive growth of population, of jobs. So we've focused, and I'm going to use West Palm Beach because that's where we're focusing. We've looked at some deals in Miami, but again, I think South Florida in general, you could replace it with Nashville. You could replace it with, Austin, or again, some other similar types of cities. In West Palm Beach, it's got this moniker, the Wall Street of the South. What's happened is an unbelievable number of financial services firms, 140 financial services firms have moved and opened offices in South Florida. These aren't little firms. Goldman Sachs, Point72, and Elliott Management, 2 of the largest hedge funds in the world. New Day Financial, BlackRock, Citadel. These are kind of world-class companies and names, and they've all opened businesses in South Florida in West Palm Beach. So, Palm Beach County, 2.6% unemployment. There's no unemployment. Just to give you a few statistics, on the island of Palm Beach, there are about 2,500 homes. The average, and at any given time in sort of a normal market, 200 homes are on the market. There are 20 homes on the market right now. And an average, like a very nice house, mid-block, not some amazing like palace on the water, average house is $11 million on the island of Palm Beach. So now you look over to West Palm Beach. West Palm Beach is actually, it's not a wealthy town. It's 2/3 people of color. It is not a wealthy town. West Palm Beach is now going through incredible growth as people come down to southern Florida in general, as businesses open up in West Palm Beach in particular. Related, you may know the name Related, is one of the largest real estate companies in the world. They're trying to buy up every square foot of West Palm Beach. And Related is building today about 1.8 million square feet of Class A office space in West Palm Beach. Now, if you do the math, you can put about 200 employees per square foot, 200 employees per employee. So if you take 1.8 million square feet by 200 employees, that means they're going to fill those buildings with 9,000 employees. Those are 9,000 employees that have not arrived yet. The buildings are under construction yet, but a lot of that space is already pre-leased to some of the premier asset management and financial services companies in the world. So those are 9,000 people that are coming to West Palm Beach, and they all have to find somewhere to live. So we are building a project in West Palm Beach right now. This is called the Olara. It's right on the water. We'll be driving piles in January. So it's 275 condo units on the water, and then 170 rental units in a tower off the water, built at the same time over a common podium, but effectively 2 separate projects. The day we finish, separate entrances, separate lobbies, separate parking, separate in every sense. And what we're doing is there are 9,000 wealthy employees coming to Palm Beach over the next 3 years, and they're our market. And where are they coming from? Well, and just to show you where this is the island of Palm Beach. This is West Palm Beach. Here's our project on the northern edge of West Palm Beach. And so it gives you a sense of where it is. And then just briefly, I'll just show you, this is the lobby. There's an amenity deck with multiple pools. There's, fitness centers, spa. These are interiors. So where are the people coming from who are buying our condos? So we're selling every day now. We have a sales office. It opened up about 3 weeks ago, but we've been pre-selling now for about 8 or 9 months. Overwhelmingly, our buyers who are wealthy people are coming from New York, first and foremost, then from Connecticut, New Jersey, and then also from California. So where are they coming from? They're coming from high tax, high regulation locales, and they're not just buying real estate. They're moving their businesses. They're opening satellite offices. And it's directly at, I see it because I see it from New York, and I see it from Florida. It is at New York's expense. And there's the pull, which is lower tax, less regulation, more favorable business. There's also the push, and the push is deteriorating quality of life in New York. And I live on 71st between 3rd and Lexington. I have daughters. I'm worried about my daughters walking around the streets in New York. Crime is up. The city is less clean. The services are not as good. The quality of life in New York has deteriorated very, very substantially over the last 7 or 8 years. I think Adams is doing everything he can to stop the hemorrhaging, but it's a very tough environment. And by the way, as your business base declines, you have less and less revenues available to support the progressive programs that you want to support. So it's not a good pattern. And by contrast, Mayor James of West Palm Beach is a progressive Democrat. I've gotten to know him very well. He's a black African-American individual. He is all about promoting affordable housing. He's about building schools. He has a very progressive agenda, but he's very pro-business. He is pro-business because what he recognizes is our project, which we're building, is going to create 1,400 jobs a year for the next 5 years. And we're hiring painters and drywall contractors and electricians, right? We're putting the 65% of the people in West Palm Beach that are not wealthy, we're putting them to work. And we're dramatically expanding the tax base. And that gives him the resources that he can to promote affordable housing and schools and other things. So when you talk about a welcoming regulatory environment, I've seen it, I've lived it. It's a lot easier to get things done in West Palm Beach with the support of a very progressive Democratic administration in West Palm. In New York, it's impossible to get anything done, right? It takes. I can't even tell you because we've done it for 30 years. We're very good at it, but it's impossible to get anything done. And you contrast that to West Palm Beach, and it's not just lip service. It's really a more favorable environment to do business. I would say Florida and the Sun Belt cities are thriving at New York's expense, and I expect they'll continue to do so. So, the conclusion. Next slide. In my professional life, there have been a lot of crises. I have lived through and I have managed our business through multiple crises in New York City. Starting off, I came of age, I took my first job in chemicals. Chemical is now JP Morgan, but I took my first job at Chemical Bank's real estate group in 1989, and there was a national real estate crisis that hit New York. New York recovered. Then the Thai debt crisis spread globally, hit New York hard in 1998, New York recovered. 2000, the dot-com bubble exploded, right? That hit New York hard. And then September 11th, massive. I remember when people said the following 2000, no one's ever going to go to an office building again, right? New York recovered. Global financial crisis. New York was in the absolute heart of it. We were in the heart of it. It was awful, right? It was, New York recovered. Hurricane Sandy, the office buildings had 4 feet of water in the lobbies, right? New York recovered. COVID, we went through it. New York's actually doing pretty well. It's actually recovering from a fundamental, not the capital markets basis, but from a fundamental basis recovery. So New York has, just in my short lifetime, had gone through, it's gone through terrorist attacks. It's gone through weather events. It's gone through global pandemics. It's gone through, massive global meltdowns. And every single time it's recovered and come back to new highs. So I have great faith that New York will recover. It's going to take a couple of years. And it's not 1 or 2 years. I think there's 4, 5, 6 years before New York recovers. And why do I also have confidence? If Florida and points south suck 1 million square feet of tenancy out of New York businesses, or 2 million square feet, it's a rounding error, right? New York has the infrastructure of global business. And it's taken many decades to develop that. And that infrastructure exists, and it has the human resources that no other major market in the United States has. And sort of anecdotally, I have 4 kids, 3 young adult children who've recently graduated from college. 2 of them are living in Williamsburg, each with college roommates. Every single one of their friends want to come in and work in New York. Like all of those young professional kids who are at the early, they all want to come to New York. And my daughter went to Vanderbilt. All of her friends from Vanderbilt want to come to New York. So, and they're coming. And so when, you may not know, we negotiated years ago the lease with Amazon to come to New York, and they were going to come to our building. Sadly, they didn't come. That was a sad moment. But we spent a year with the Amazon folks, and they were not coming to New York because they particularly wanted to come to New York. They were coming to New York because they could hire 50,000 really smart people. And that infrastructure of human resources, the infrastructure to support that, exists in New York on a scale that doesn't exist anywhere else. And one other, Mayor Suarez is the mayor of Miami. And about a year ago, he came to New York, and a law firm called Greenberg Traurig, which is a Miami-based firm, set up a meeting for him with 7 or 8 real estate people in the room, and I was one of them. And Mayor Suarez came in, and he was actually super smart, interesting, practical, straightforward guy. And he said, "I'm here just because I'm trying to get you guys to come and invest in Miami, right? That's why I'm here. So I'm going to try and keep the taxes low. I'm going to keep regulation to a minimum. I'm going to try and keep the streets safe and clean, right? And in the meantime, like anything I can do to if you need help, if you need introductions, here's my cell phone, right?" He said, and I was trying to think, can I imagine Mayor de Blasio like going into a room and saying, "We're trying to bring business, here's my cell phone, call me if you," I mean, he was very practical and just, I mean, I left thinking, that guy's a great mayor, right? He's really, he's trying to do a good thing for his city. And again, his point was same as Mayor James. He wants to support all kinds of progressive programs in Miami. The way he does it is by building the business base. The way he does it is by attracting firms to invest in Miami. So I was very impressed with him. But I did say, Mayor Suarez, if Google wants to move to Miami and scale, and they want to take 500,000 square feet of space and then fill that 500,000 square feet with 2,500 people, can they do it? And his answer was basically no. There is no 500,000 square feet of space. There aren't 2,500 people available to work for Google. So, yes, Miami and West Palm and Nashville and these other places can take some business from New York, and they will, and I think they'll continue to do so. But at the end of the day, I think what they're going to take is I mean, a rounding error is probably too strong a statement, but both things can be true at the same time. That businesses can continue to flow, wealthy individuals can continue to flow to some of those places, but the infrastructure of global business exists in New York, the human resources exist in New York, and New York, I think, has a culture and history of reinventing itself in recovery. And I think given time, both of those things will be true. New York will recover. I think it'll hit new highs. But in the meantime, Florida and some of these other points south are going to prosper. So with that, that's a quick summary, and let's open it up, and happy to have chats about whatever. Right. Yes.
First of all, thank you for a fantastic presentation. This is unbelievably interesting. 2 questions, if I may. One New York related and one Florida. In New York, when you're looking at the secondary market, the undesirable side of the commercial real estate market, any potential for conversion to residential in that market? In Florida, to what extent, if at all, do your business plans take into account the potential effects of climate change on South Florida?
So two really, really good questions. So I'll deal with the first one first. I think this notion that is spoken about in the press a lot about, hey, let's just convert it to residential, right? Why not? It doesn't work as an office, let's convert it to. First of all, if you look at a building, the building has to have the physical attributes that allow it to be converted to residential. It has to have the right fenestration. It can't have the right depth. Its access egress has to be appropriate. Its column spacing has to, its ceiling heights. So 1 out of every 6 or 7 office buildings is even, forget whether you can do it, is even convertible to residential because you run into one of these constraints that make it impractical. But it's not, that's really not the problem. The problem is it's really a math problem. And I'll walk through it. But I'll start with the end game. If you're really, really successful in taking your office building and converting it to residential, you're gonna get $90 per square foot in rent. But you're gonna have $30 a square foot in real estate taxes and operating expenses. So you're gonna net $60 per square foot. How do you value that? Well, this is being really aggressive. It's being optimistic. If you value that at a 5 cap, then it's worth $1,200 per square foot at the end of the day. But it's not, because this is just an office building is leased to its 4 square walls. You lease 100% of the space. Residential, you're only renting or selling what's inside the walls of the apartment. So you lose 15% of the building when you convert it, right? You're not selling the lobby. You're not selling the elevator chases or the common areas or the mechanical rooms. So you lose 15 to 20%. So your $1,200 becomes about a little over $1,000. So at the end of the day, if you're completely, like everything works and you're successful, you have something that's worth $1,000 a foot. What's it gonna cost to get there? Converting it, we've converted a lot of residential, industrial and residential office buildings to residential. $300 to $400 per square foot, hard costs. Then on top of that, so let's say it costs $350 a foot. On top of that, your soft costs, your architects, your interest carry expense, your engineering costs, $200 to $300 a foot. $250 to $300. So let's say it's $250. So now you're at $350, $450, you're at $600 a foot. You haven't bought the building yet. You have to buy the building. Buildings are not selling, like buildings in New York sell for, have in the past, they're not a lot of sales right now, $400, $500, $600 a foot to $1,500 a foot. I don't see a whole lot of buildings selling for $300 a square foot, but even if you would, you're now effectively at your basis and you haven't made your exit value, you haven't made a profit. So again, $350 hard cost, $250 soft cost, $300 a foot, maybe if you're lucky and you can buy the building, you can't make any money. There is no money to be made. So why is it that this has happened in the past? Liberty bonds. It happened in the financial district because of widespread government subsidies. And that's what you need in order to make residential conversions. Listen, there's always a needle in the haystack. There's a particular building that is particularly well suited for, but if you actually want to, and where the numbers work, but if you actually want to address the real problem, which is that you point a big problem, the obsolescence of many, many buildings, is it will only happen with large-scale government subsidies. So that was the first question.
Climate change.
Climate change. Our insurance costs in Florida gone up 100%. Not 10%, not 20%, 100%. Now, it's a major issue down there. It's making certain floodplain areas, you can't get insurance, or your insurance goes up, to stratospheric levels. Our particular project, it also then bifurcates the market. Our particular project is being built to the highest resilience standards. We're building it 9 feet above the the floodplain. We're elevating all the mechanical systems, so to the second and third floor. We're putting in hurricane-resistant glass. So we're building a super resilient building. So in our case, it's the building that insurers want to insure, and it's a building that residents want to go to when they don't go to the older building that's in a floodplain and that hasn't had all those improvements. So again, it's bifurcating the market, but it's a major, major problem. What is amazing to me is people are paying $75 million for houses on the beach in Palm Beach, which is basically just a sandbar. And like, I don't even know what they're thinking. Maybe they're just so rich that they don't care. But yeah, I think it's a major, major issue. And I think there's a certain amount of blinders that people have on when they buy in Southern Florida, and they just kind of think, oh, it's not going to happen to me. Okay.
You're John Williams, the head of the 2nd District Fed, and you want to achieve the best soft landing possible. And that involves certain decisions as to how long you keep the interest rate very high.
Yeah.
It involves matters of timing, matters of judgment, and you don't want a section to collapse too much.
Right.
What advice do you give to Jerome Powell as to what you should be doing in regard to the real estate market in New York?
So there are rare circumstances where we kind of have insight into the future. We do have I have some insight into the future right now because we are bidding out several very long-term, large-scale projects. This one in Southern Florida is one of them, right? So we're going to be building. This is going to cost $1 billion to build. Okay, it's a very, very big project. So we're bidding out the largest. I'm sorry, excuse me. It's going to sell for $1 billion. It's about a $600 million build, which is a huge number. We are in the supply chain right now, talking to major vendors. We're talking to foundation contractors. We're talking to elevator and facade consultants, and we're pricing the job right now. We're bidding it out. We've been in this process bidding it out now for probably 18 months. And for a period of time, over the last 3 or 4 years, just every month, prices were going up.
Yeah.
We locked in our initial pricing about 6 months ago, and now we're going out to get final pricing. Costs are coming down.
Yeah.
Costs are coming down almost on every trade. And not only are costs coming down, people are available. Right. When we went out to bid the foundation contract 6 months ago to get initial pricing, and we have to use the largest contractors in Southern Florida, there's 7 of them, only 2 bid because the others were just too busy. It wasn't even worth it. We just went for final pricing, all 7 bid, and they're competing with each other on price, and so pricing is coming down. So we're going to end up, I think, being under budget. Maybe not massively, but it's clear to me the supply chain issues have been solved. The cost curve is turning. And I think that, I hope that Jerome Powell and others are seeing that because I think that's bringing inflation is coming back in. The costs are coming back in. And I would certainly hope that we're not going to continue to see further rate increases because, second part of my presentation was how devastating that is to not just 1 or 2 buildings. That's almost every single building in America, right? Every single significant office building in America. And I think the potential contagion effect of wide-scale defaults is a little scary. And by the way, then you look into the banks. You look at what happened to First Republic Bank, Silicon Valley Bank, Signature Bank. Like, if you look deeply into the balance sheets of other lenders, they're carrying loans that are way under market, right? If you mark those loans to market, their capital disappears pretty quickly. So I think I think it would be good for the economy if we were done with further rate increases, and frankly, if we began to turn the other way.
Yeah. You talked about people coming back to the office in New York particularly. And I'm wondering how an area like ours, which specializes in small cities and commutation from the city, can find technological or other niches that they can not be New York scale, but they
Right.
can be an outlet where the costs are lower and the throughway to New York City takes 2 hours.
Yeah. I already think that communities that used to be second home communities to New York residents have become much more primary, or people are just spending a lot more time. My wife and I have a house on the other side of the river in Millbrook. And so there's a whole community there of our friends. A lot of them moved up full time to Millbrook during the pandemic, and now they're spending a lot less time in New York City. And again, that goes to technology. They're able to work they don't have to move out of New York full time, but they may only be spending 2 or 3 days a week in the city, and they're spending those extra days in Millbrook.
Finally, one of my daughter's boyfriends is a digital nomad
Yeah.
who had moved to Bath, Maine, where he changed jobs from something that allowed them to go to Peru, Colombia, wherever.
Yeah.
And now one of the conditions of his going back, of his getting a new job in Bath or Portland, is that he reports to work every day for 6 months.
In the office?
In the office.
In the office, yeah, that's correct. Yeah.
This seems to piss off young people. And
You're right. You're right.
You can't
You're right.
necessarily
You're right.
have it your way all the time.
Look,
Especially with young and sometimes very interesting people.
I'm ashamed. I see it in my own children. My own children who are now out of college, they don't really want to go into the office, right? My son works for a tech company that's based in Nashville. I don't know that he's ever been to the office. He's on the marketing side. My daughter is now looking for a job, and she really, really doesn't want a job that is going to ask her to come to the office every day. And again, my personal belief and philosophy is it's really good for you to wake up in the morning, to get out of your pajamas, to shower, to go into work, to work among peers, to establish relationships. Yeah, it's just like, do you really? What's that?
You are the only one.
I know. But so I think you're absolutely right. I think in particular this young generation who've grown up in COVID don't really want to go into the office, and I think it's terrible. But I think that employers, certain employers, the tech companies, give people more. But a lot of other employers are now saying, now's the time. Get back in the office. And by the way, if we do go into a period of recession and there are cuts, I think the people who get cut are the people who are not in the office. Yeah. Those are the easiest people to cut. So I hope people are coming back. I certainly see in New York that gradually they are coming back. But structurally, the market is different now, and I think some component of work from home is here to stay.
Mm-hmm. Well, the not coming back crowd has lasted a lot longer than people like you suspected.
Yes.
And
yes.
It really doesn't give much sign, unless there's some serious economic trouble, of that share of labor. The labor market decreases except unwillingly.
Right.
Yeah.
Right. I agree.
Okay.
Yeah.
Thank you very much. Fascinating presentation. 2 questions. How did New York City increase its diversity? And is it going back again to finance? Is that reduce its resilience?
So I think I don't have a really good answer for how it increased its diversity. I will say that what I noticed was that the massive mover was tech. That tech started to come into the New York economy in the early 2000s, and you started to see, Google bought a building called 111 8th Avenue, and then they bought the building next year. And this is all in the meatpacking district, which is now super chic. And then we actually brought Facebook. Facebook took a building that we built, and then once you had kind of the big boys like Google and Facebook, then all of a sudden everybody else started to cluster around. That's when I talk about the ecosystem of business. These firms like to be around their peers. And then the support companies, the third parties that service them or consultants to them build up. And so that always existed in finance. Then it grew in tech. Now in media, you see it. Disney has established its headquarters. So I don't really know why, but it definitely happened. And once it's happened, it exists, and it's very hard for other markets to compete with it. But I don't have a good. Again, it may go to human resources. That just the scale of the city, the ability to hire, large quantities of really talented people. The educational infrastructure.
So the other question is the commercial real estate overhang that you were describing. What's the chances of another big collapse?
So here's the similarity. I see a lot of similarities to what happened in 2009, 10, 11, because what are called the capital stacks, the debt, the equity are upside down. The economics don't work in many ways like post during the GFC. But what's not systemic, it's more situational, less systemic. What's not systemic about it is at that time, the banks were grossly undercapitalized. And you had the Fed coming in and saying, all right, clear your bad assets, raise capital and clear your bad assets. So they were forcing Lehman Brothers and Wachovia and even the healthy banks that survived to sell their bad assets in the market. And so it came out in a wave, and it was a forced sale, and it just sold for whatever price is sold. And then what actually happens is new capital comes in, everything gets repriced, that establishes a new baseline, and then the market actually recovers. So that's what happened during the GFC. You don't have the same. The good news is, with the notable exception of the three banks that I just named, you don't have a massive problem within the financial system the way you did there. So you don't have the Fed saying to banks, clear your bad assets, and they're able to deal with these, and they have much more, they're much better capitalized than they were at that time. So they are able to deal with their problems on a situation by situation basis. So a lot of the same situations exist, but it's not systemically threatening the financial system.
Then my last cynical question is, who would want to move to a state that bans books and abortion?
I'm not moving. No, yeah, there's a lot of conversation there, but I think people are moving, I think, for mostly economic reasons, so. Yeah, well, I think.
One more question.
Sorry, thank you, Nick. I'm wondering, what do you see the next big thing is as a result of this high interest environment, particularly in real estate industry or opportunity area?
Well, look, our existing, I'll speak on a very personal level, our existing portfolio of assets in New York is going to do badly, right? Unfortunately, and so is everybody else's. We're going through a tough period right now where we've done workouts on 6 deals and we're doing workouts on another deal. A workout is when you sit down with your existing lenders and you say, this is not going well, let's figure out how to stabilize this asset. So our existing portfolio isn't doing well. Nobody else's portfolios are doing well right now. And there's going to be a tough period of 2 or 3 years to work that out. But the flip side of every, the opposite side of every dark cloud is there's a silver lining. The silver lining is there is, I think, a once in a generation buying opportunity over the next 2 or 3 years, where if we can raise capital, unbelievably good office buildings in the heart of Manhattan are going to be selling for shockingly low prices. So I think from there is an opportunity, and I believe in the system, and I think the way the system is going to work is just the way it worked then, is that these assets are going to be sold, they're going to be repriced. Certain amount of capital is going to be destroyed because in that process, but again, that'll establish a new baseline. People invest in the properties, and then they'll come back. So we're trying to position our company to be in a position as these assets come to market in 2024 to be, align ourselves with partners and to be on the buy side.
I think we should wind it up. Thank you.
Thank you all very much. Thank you. Great.